the first six right now, marginally in the red, skirting around that 19,355 odd print. Let's see what Auto Pharma is up to. Strong numbers coming in there. That stock will just come off for you on your screens. And then, of course, a 0.7% move. Vedant Fashions, wherein Morgan Stanley maintains their overweight with a target price of 14.18. That stock, though, starts off absolutely flat. Strong numbers among small caps as well. So, growth is also the one which is backing the momentum within small caps. Subros, eClerx, strong numbers from both these companies. Look out for what these stocks do. 5.5% higher for Subros and eClerx as well. A big jump up of 5%. Nazara, Concord, both have seen a downgrade coming in this morning from Jefferies. Downgraded the rating now to a hold from the earlier buy. Piramal Enterprises, muted set of numbers in the second quarter, so that's another stock which is going to be sensitive to its earnings. 1.25% lower for Piramal Enterprises as we speak. Hero Murkov, wherein the High Court has now stayed the DRI proceedings against Pawan Munjal. That's the other stock which is in focus. Let's see what M&M is up to ahead of its numbers. And that big rally in the stock yesterday starts off with a downtick of 0.7%. There's also Power Grid, which came out with its numbers. Also the fact that they've raised the FY24 capex target now to over 10,000 crore rupees from the earlier 8,800 crore rupees, marginally higher for that one. Z Enterprises, the Q2 numbers are above estimates. Sony's push for top post calls has been stalling the merger talks. Z downtick of 0.7%. Good numbers from Torrent Power, good numbers from NBCC, GSK Pharma, GR Infra, AstraZeneca, whole host of earnings reactions coming in there. Also, some weak numbers coming in from Muthoot Finance. The Q2 numbers were below estimates. The NIMs came in at a 5-quarter low, that of roughly around 11%. It's a 6.5% crack that you're seeing for Muthoot Finance this morning. Piramal Enterprises, let's revisit that stock as well. Weak numbers there too. The profits have slipped 45% year on year. 5% sequentially. AB Fashion, RVNL, Campus Active, NCC, all a weak set of numbers. Kunal, what's looking good to trade?
Yeah, so I think again very similar kind of expectations for the indices, but in terms of individual stocks, Coal India is something which looks attractive. Yesterday the stock gave a breakout above the 320 mark, so we'll be looking to trade on the positive side for the stock.
All right, let's find out what Naresh's take is as well on the market open. And Naresh, what's the first trade you're punching in?
So, buy on City Union Bank, which showed a lot of movement yesterday, relative strength as well. Expecting it to see some follow-up.
Let's make sense of the somewhat gone by and what lies ahead of us. Who better than Prashant Jain, Director 3P Investment Managers, to highlight exactly that. So it's over to Nikunj for a chat with him.
Ye Diwali, Muskaan Wali. That is the theme of ET Now programming this Samvat. And it's been a year of smiles. And it's been a year of good returns, both on absolute basis and on relative basis. It's been a year where if you participated, you just kept the faith, you actually were rewarded very smartly. And my guest on the show, while he's got lots of reasons to smile, the stock ideas, the themes, his journey as an entrepreneur, everything has been off to a great start. So with that big smile, let me now welcome Prashant Jain of 3P on ET Now. It's been a good year. So let's start with the Muskaan, Badi Muskaan.
Yes.
Your stock ideas, the themes which you identified and your entrepreneurial journey, everything touchwood is off to just a great start.
No, that's right. Thank you so much. And wish you and your viewers a great year ahead too.
It's been a good year actually, if you look at both the absolute returns and the relative returns. In a year when interest rates went higher, there was scare of inflation, there was war in the world. Equities in general, globally and locally, have done well.
So that's right, Nikunj, and especially in India, I think we have been quite resilient. and I have always said that the Indian economy depends less on the external world. And the biggest surprise was, if 2 years back someone had told you or me that, look, US yields will go from 1% to 5%, what should we do? Well, probably a reaction would have been, be very, very risk averse. But that has happened, and here nothing has changed. So I think one big change which has taken place over the years is the coming of age of domestic equity flows. And between, I think, September 21 to June 22, foreigners sold almost 2 lakh crores worth of equities, and markets didn't budge. So I think these markets are, earlier the economy used to be less dependent on outside events. Now I think even markets will display that, and even markets will be impacted less by foreign events, by foreign outflows, because local investors are clearly now in charge, domestic flows.
So the power has shifted.
I think so.
Why has that happened?
No, clearly because, see, over last 30, 40 years, the understanding of equities with the masses has improved dramatically. I mean, I have been in this industry for over 30 years now, and 30 years back it was all speculation. Money, only momentum, money would come only in good times, never in bad times. There was no monthly flow of equities. So I think all of that has changed, and all credit must go to the regulators, the media, the mutual funds, the banks, the distributors, the IFAs. Everyone has done their bit, and the understanding of equities as a long-term asset class has improved dramatically, and that's what you see today. I feel, in my estimate, almost 3 lakh crores worth of money is flowing into equities in India, and it is fairly, I would say, not entirely, but substantially it is acyclical.
What is the breakup of that 3 lakh?
So I think bulk of it, 50 odd percent should be probably mutual funds. I think 30 odd percent should be EPFO, NPS, and balance, I think AIFs and PMSs would have a very small share, and the rest would be insurance companies and direct equities.
So there are two things to look in market always, and that's what you've always done: bhav and bhav, price and sentiment. So let's look at price where we stand, because as a value investor, you like to buy growth at value. This here solely and truly belongs to small cap stocks, not even small cap stocks, actually SME. The lower you go, the better returns are. So SME is done better than everybody else. Then it's small cap, then there is mid cap, and there is large cap. Why is that?
No, I think these are phases of the markets, and I don't think we can explain these. Even with hindsight, I don't think there is. But what I have seen is that wherever there is more momentum, a lot of investors flock in that direction, and that has happened earlier across sectors. So 99, 2000, technology was the hot favorite. 2007, infra, NBFCs, power were the hot favorites. 2012, 13, 14, pharma was the hot favorite. And last few years, it was banks and power, and now it is small mid cap. So I think what has happened in the COVID correction, the sharp correction, large caps fell maybe 30-40%, but small mid caps fell 60 to 80%. That's the nature of that asset class. And as things normalized, economy, life and markets normalized, because of the extremely low base, the returns in that space were much higher. And that period also coincided with the massification of direct equity investing. I mean, the number of demat accounts that have been opened is there for all to see. So I think digital adoption, low base, favorable outcomes, all of this came together, and that experience, I think, has been reinforcing itself, that positive bigger returns in small mid cap. So what we are saying, I think, is a play out of that continuation of the same theme. And clearly, I think at this stage, while I don't know about the SME bit, I have not seen that at all, but across small and mid caps, I don't see any value. And I mean, if you look at 100 companies, maybe 2 or 5 will appear to be reasonably valued. I would say 90-95 of them, even the good companies, are not offering value. So I think the long term outcomes of investing in this space, I think, will be mediocre at best.
You've always argued in the past that if you look at the long term return, compare the small cap index with the mid cap index and then compare with the large cap index and take a reasonable amount of time, a 5 to 10 year period, actually the performance is quite neck to neck. So now that small cap stocks have run ahead of themselves and large cap stocks are still very cheap, so going forward, do you expect large cap stocks to do well? So what we are discussing this Diwali, Prashant, is outperformance in small and mid cap stocks. Next Diwali, or maybe after 18 months, we could be discussing the reverse.
So I think it is possible, Nikunj, but in stock markets, as Warren Buffett has said, markets may remain irrational longer than you may remain solvent. So the message there is that what is expensive can become very expensive, and what is very expensive can become terribly expensive, and what is cheap can become cheaper, and what is cheaper can become very, very cheap. So then excess may take several years to correct. So I think at some point of time this will correct, and that's why I said the long term outcomes should at best be mediocre in that space, but hard to say whether this will correct itself in the next year or so, because you are dealing with a situation where crores of investors are participating directly. A lot of money is flowing in, and the more this does well, the more it reinforces that behavior. And even if people know they are expensive, many of us or many investors take the view that yes, when it starts correcting, I will move out quickly. It never plays out in the end like that, but that is what sustains this, and we have seen this classic case in between 88 to 92. So in 92 the markets peaked at 45 PE multiple. So even at 30 they were expensive, but they went to 35, 40, 45. It happened again in the case of technology. In the case of technology, these IT companies were trading at 600-700 PE multiples.
600-700? Oh,
Yes.
I thought they peaked out at 100 or something.
No, the PEs went up to 700. So what is expensive? So this eventually it will correct, but whether it does in 1 year or so, I don't think is easy to guess.
When we spoke to you last time, just about 5 months ago, you said that in market there is always something which is very expensive, and in his market there is always something very cheap. But you said for the first time in almost 30 years, you were staring at a market where nothing was very expensive and nothing was very cheap.
In the large caps.
In the large cap stocks.
Yes.
Has that pecking order changed now?
No, I think these markets have continued to moderate at both the extremes last 2 years. So if you look at last 2 years, what were very expensive sectors, let's say like the consumer space, the private banks, retail banks, the software companies, they've all been correcting, multiples have been moderating. And you know the large private banks are now, some of them have derated quite sharply.
They've gone back to levels of pre-LNFS now.
Yes. So even consumer companies continue to experience a time correction. So multiples are slowly coming off. IT has corrected meaningfully. On the other hand, sectors that were very cheap, let's say the power space or the corporate banks, there the multiples have moved up. So I think, as I think John Templeton has said, that mean reversion is the iron rule of markets. I think.
And you're a votary of that. You've always said that markets have to mean revert.
See, I think because excesses will not sustain in a market, because markets may be imperfect over short to medium periods, and medium period can be even 3-4 years. But in the long term, market irons out any imperfections. So I think we are in that phase, and today I would say sectors are coming closer and closer to their real valuations in large caps.
Markets are very smart in identifying what's next. You know, they focus on where the puck is moving. They always vote for rate of change. The rate of change for banks has been nothing sort of stellar. Low NPAs, high credit growth, high retail growth. Corporate loans are also growing decent, but banks are underperforming. Why? And how long will this continue?
See, I think what happened, if you look back, there was a clear divide between corporate and retail banks.
Yes.
And the corporate banks were suffering because of high corporate NPAs, and they got derated to absolutely low levels. And therefore, as a result, all the money crowded into the retail banks, and they became terribly expensive. A 4-time, 5-time price to book for a retail bank, it's a good bank, is very expensive because the ROEs are capped at the end of the day. But as the NPA cycle resolved and the real strength, the profitability of the corporate banks was evident, these banks have done extremely well. So you can see those banks have moved up 3 to 4x. So I think what has happened, that excess valuations in the retail banks, that has corrected, leading to underperformance. And this always happens because when there is scarcity of growth, growth becomes expensive. When growth becomes cheaper, available elsewhere, that excess is corrected. So I think that is what has played out, and that's why you will see the derating of the retail, erstwhile retail banks. I think today the valuations appear to be quite reasonable across, and the gap between corporate and retail banks has disappeared. The balance sheets are looking a lot similar to each other, and the valuations as well. But eventually what happens when there is no momentum in some space, markets can become less interested in that space, and they may actually go below fair value also. So I think that could be playing out in some of those.
So next leg of the rally could be the classics, the HDFCs and perhaps the Kotaks, which could come back?
See, I would say that big divide what you saw between these banks and the corporate banks, I don't think that is likely to reoccur.
Okay.
Because the businesses have become similar. The erstwhile retail banks have grown faster in corporate loans, and corporate focused, loan focused banks have grown much faster in retail loans. So I think these banks are quite close to each other. So I don't think that a big skew in valuations is likely. And who knows, to be honest, whether the next NPA challenge, whenever it is there, 3, 5, 7 years down the line, whether it is in retail or it is in corporates. That is also a moot point.
Yes. No, so what do you mind next 3 to 5 years is the tactical and the structural trade. For example, just for the benefit of our viewers, Prashant Jain, I think in 2017-18 was almost very clear that go for corporate banks and go for PSU banks because they were very cheap. Now could the reverse happen?
I don't think so, Nikunj. I think in this market, as I said, very few, I mean hardly anything in large caps is very cheap or very expensive.
Okay.
This is a market where valuations are coming close to where they ought to be by the day. If at all there is some scope left for some change in multiples, I think it is in the power sector.
Okay.
And to some extent you can argue that for large banks as well. And as I said, the divide between corporate and retail is not there, but banks as a category I think can slightly re-rate over time, and so can power.
For the longest time, I have tracked Prashant Jain and his public portfolio, and what we understand is available, right now in the public domain of your new funds. You've never bought very expensive high PE stocks, but suddenly I see there is an Indigo there, I can see a Zomato there, I can see an RR Cable there. In your second innings, are you approaching investment differently?
No, Nikunj, I think, I have always, what I have always said is that I am willing to pay the right price for a right business, for a right price for a business. That right price can be a higher PE for a business which has long big headroom for growth or for fast growth. So these companies, they enjoy the airline business in India, the food delivery business in India. It has a long runway of growth. I mean, only I think maybe 5 crore customers fly in India once a year total, and same number of customers roughly order on food delivery, on this. So that's hardly 3% of the population. So as purchasing power grows, I think these two spaces will experience rapid growth, and the market structure is also pretty nice in both these businesses. So if you look at the market shares, 2-3 companies are probably 80-90% of the market.
So can the food delivery business and the airline business, can they be compounding in terms of earning? I mean, 3 to 5 years, somebody's take a long haul view.
I think they can. I think they can. Only thing is, in the airline space, it is very easy to add supply. So market shares can change over time. So one has to be a little more alert. But the nature of the food delivery business is such that it is nicely consolidated. There is no third, fourth, fifth meaningful player. I think that is less likely also. So new players entering or market shares realigning is, I would not say it will happen, but it is relatively easier to change in airlines than in the food delivery space.
We had a conversation on a different forum, but that was a conversation in 2019. And I think that was the first time I heard anyone saying that India will actually be shifting its manufacturing in areas like electronic. And today everybody is excited about it. And now data which is supporting that. This theme which you identified pre-COVID, and my sincere compliments. I remember we had this chat. Is this a multi-year trend? Do you think this will last for next couple of years?
No, I think it will last for few decades. Because
manufacturing in electronics or manufacturing across the board?
Both, I think.
Okay.
But in electronics, we don't have the ecosystem. So we will take longer to scale up. But in other areas, we have reasonable ecosystem in place. So there the progress will be faster. See, I think everything is aligned as far as this space is concerned. Our wages are comparative compared to Chinese wages. They are far lower. Even if you adjust for lower productivity, we are reasonably in cost. Wages are also comparable to Vietnam. So there is cost comparativeness in India. Then the post lockdown in China, when you disrupted huge supply chains, and post the Ukraine war and the issue around Taiwan, I think large global companies would want to diversify their manufacturing footprint because it's a strategic need, it's a de-risking objective. So I think whether it is Vietnam or India or Thailand, all of these destinations will grow. India has the benefit of huge size with it. Its economy is much larger. India has gained tremendously in reputation, in confidence globally. So I think whenever I get to speak or get to hear, I think there is across the board, whether it is automobiles, whether it is electronics, assembly, across the board I think manufacturing will shift to India. But we should be clear, see, to shift a factory will take 3 to 5 years. So in services you can shift jobs in 3 months. So we should be reasonable in our expectations. So I think it's a very trend that will progress for a few decades, but progress will be slow and steady.
So for someone who's watching the show, he says, okay, I did not pay attention to Prashant Jain in 2019. Now I'm put to pay attention to. I like manufacturing. So what's the best way for me to invest in this manufacturing theme?
No, unfortunately, most companies are very expensive. See what happens, and this is what happened to chemicals also, if you see few years back. See, these narratives are very easy to pick, and the market over discounts these narratives.
And these days, everything is so fast and quick.
Yes. So the business may take 10 years to scale up, but the price moves up a few times in few months. So I think most of the plays on this theme, to my mind, are very expensive. But since this is an evolving theme, I am sure there will be some companies which will create wealth, but I am not able to, at least currently.
You've been shopping a lot in IPOs, and typically IPOs have a reputation that they never leave anything on the table. These are priced to perfection stocks. You know, the promoter wants dough, merchant banker convinces him to sell higher. You've been shopping, and some would say that value investor shopping in IPO?
No, I think we have been, see, maybe 0.25%, 0.5%, 1% of the fund. So I think there is very high discipline with regard to that. So when the company is good, and even if valuations are expensive, in 1% of the portfolio we can participate. But if you look in percentage of portfolio terms, you will see it is actually insignificant.
I'd like to draw attention to a sector which you, I think, said in 2016-17 that had become a mature sector. Do you remember which sector you told me? See, I remember it. 15-16 we had a conversation. IT. So, you say IT had become a mature sector. And now there is a reversal. For a sector which went through massive re-rating post-COVID is going through de-rating. What is happening there? The order books they tell us is very fat, but translation is not happening. Every CEO we speak to, they said, okay, Indian IT has to be there because everybody is cutting cost. If the setup is so large, if order booking is so large, why are the numbers are not coming?
No, I think what one probably meant by maturity is that the growth rates are mature.
Yeah.
So the growth rates have stabilized, and you can see that. So last 5-10 years, growth is in high single digit in dollar terms. So I think those growth rates will sustain over time. But I think what happened in the COVID year, there was slight degrowth because corporates pushed back on discretionary spends. And the moment world opened up, there was rapid digital adoption. And Indian companies did exceedingly well in terms of adopting to work from home, which probably some of their global counterparts did not do as well. So a lot of business came their way. And the growth was pretty high for maybe 2 odd years. I think that high growth markets extrapolated that, and at the peak these companies went up to almost 40 to 50 PE multiples.
Mid-cap IT was at 40-50
Yes.
times.
So I think that was wrong. That was wrong because that high growth was due to very specific circumstances, and I think it was an error on parts of the markets to extrapolate that growth. And growth is now normalizing due to the high base of, or the big digital catch-up has probably happened, and now again you are back to, in my opinion, 6-8% dollar revenue growth for next few years. And so I think that is what is happening, so that excess in the market, those multiples have gone.
So Prashant, the template for IT is that it will grow at a rate which is lower than India's GDP. And there are companies which you can really identify which give you a 12 to 14% visible growth for 3 to 5 years. Now IT companies will defend back and say our return ratios are great, we will keep on doing buyback. But if the growth rate is going to be low and if markets always focus on growth, then why should one own large cap IT at all? 6-8% growth when economy is growing at a much higher rate, one should avoid IT, and I think that's what you've done.
See, I think 6-8% is in dollar terms. You can add rupee depreciation to that.
That makes it 10 or 11.
The 10-12%. Yeah. So I think, but India is also a lower inflation country now. So our nominal GDP is growing 11-12% only. So I think to that extent IT is growing in line with rupee GDP growth. And what you can say to their credit is that the capital allocation is one of the best. They pay out, the good companies, large companies pay out 90 odd percent of profits, all of free cash flow. So I think if you, and this business does not need any capital to grow. So if a business is growing at 12%, it needs capital, it will be valued lower. But if a business can deliver same growth with no incremental capital, it will trade at a higher multiple. So I would say IT is now coming around to, it's almost there, I think, near fair multiples, I think. So I think this business can deliver moderate returns, especially if you add back the dividends over medium to long.
So IT is not part of your portfolio, but it is there on your radar.
We are underweight. It is there in the portfolio, but we are slightly underweight.
We've also seen an interesting trend in the IT space. You know, for the longest time, the criticism was that Indian IT was all about body shopping and IT services. But a lot of SaaS companies, a lot of niche IT companies, a lot of design companies have now taken birth. Good quality, great entrepreneurs have gone public. Any thoughts there? Anything which looks interesting?
No, actually, I am not on top, and I have, there are some good product companies which are, but they are very small. There are a few. So I think that is one space where India still lacks. But see, it is Indian companies in some cases have developed good products. But that is not enough. That's just the start. To make these products, to sell these products or consumers to adopt, I think is a altogether very, very different challenge, and that needs very different magnitude of resources, time horizons, execution. So I would say hopefully one day Indian companies will have products that will be adopted globally. So far we have very small companies which have very, very niche kind of products, nothing meaningful.
It's a coincidence that Your firm's name is 3P, and one sector which you identified also starts with P, which is power. And I just want to bring this point for our benefit of our viewers that, Prashant's been talking about power sector pre-COVID, during COVID and post-COVID also. It is just that markets are recognizing them. I mean, they had become the ugly ducklings. Some were smogged because of ESG, smogged because of regulation, but now everyone is saying that India mein power ki shortage hai, bijli ki kami. So let's understand this sector. You still like it and you still find it cheap. This sector needs constant dose of money. Unlike IT, you said companies which don't raise capital, you should like them. Power has a different story. It needs to grow, it needs capital, and it's a regulated sector. Return ratios are not impressive, yet you like it.
No, I think, see, there is a fair price for everything. So a business which is generating all free cash flow, it also has a fair P. Like at 40p, an IT company becomes very expensive. At 16-18p, it starts looking attractive. So at 2 or 3p, a business which is generating 12-14% ROE and needs a lot of capital to sustain that growth, at 2p it is very cheap, and probably at 16-20p it is very expensive. So I think you have to price, that's what I said earlier, that the right price is relative to what business you are talking about. Simply a high or low PE does not mean much. A business can be very expensive at 12p and it may be cheap at 80p. So I think power, what has happened, India's power demand will grow at a fairly decent pace, because adoption of ACs in India is only 5%, and as income levels grow, discretionary spends grow, air conditioning will consume lot of power, manufacturing will consume lot of power, economy is growing in any case. This electrification will consume significant amounts of power. So I think power demand in India will grow at a decent pace, and last 10-12 years we have not invested in new thermal capacity. The mix will continue to shift towards solar and wind, but I think the markets anticipated the shift to be much, or expected the shift to be much faster than the reality. See, in India, demand for power typically peaks in the evening. At that time there is no sun. See, renewable power is not 24/7 power.
Yes.
That is the big disadvantage. So unless storage becomes cheap, you will need more thermal, and now I think it is there in the press that India is planning maybe 50 or 80,000 megawatts of thermal capacity new, including the work in progress. So I think this is what I have been saying all along, that this sector was misunderstood. And see, the right to win in power sector is with companies that borrow at the cheapest rate. If there are 3 companies and all put up solar plants or all put up wind plants, the cost of panel, the land, everything is practically the same. The difference can come from cost of borrowing, because these are projects that are typically 70-80% funded through debt. So someone who borrows half, 1 or 2% cheaper is likely to be a winner. The ROEs will be higher. So that's why I think the public companies which borrow at the cheapest rates, so that is the reason why those companies have come back in favor and why they continue to grow well and to do well. So I think that whole narrative around ESG, bleak future of thermal and PSUs, all of that came together and it created deep value in that space, but slowly all those things are correcting.
Prashant, I say this with all sincerity that you're the only fund manager who's called spade a spade. Unlike a lot of fund managers who come and say, okay, long term bullish, medium term stay invested, short term we don't know. There are periods in the market, you've come out on my show, you've come out on other forums and said, look, market is rich. Market will give you no returns. So for next 3 years out, if you have to talk about returns, what could be the returns?
No, I think in India, the large caps, I think Nifty, Sensex can compound 12% longer term. I don't see a challenge in that. Markets are now close to historic multiples, slightly higher, but I think there are 3 reasons why Indian multiples may settle higher than the past.
Okay.
And these are, 1, our growth is likely to be higher. Last 20 years we have grown around 6%. I think we should grow 7% or even higher current decade and next. So higher growth means higher multiples. Second is cost of capital has come down. India has moved from a high inflation to a low inflation country. Last 9-10 years inflation is sub 5%. the gap between Indian and US yields is shocking. It used to be 6% 15 years back. Today it is 2.5%.
Yes.
So lower cost of capital, higher growth means higher P multiples. And third, the volatility of Indian markets is slowly trending lower, and that is because of the improving share or improving flow of local savings towards equities. So I think you have faster growth, lower cost of capital and lower volatility. So I think even though these multiples are not cheap, but I think one should not remain in cash in the large cap space. So I think 12%, maybe slightly higher returns are possible. And one very interesting thing which I said earlier, see, the US yields have touched 5%.
Yes.
So now they may actually go to 5.5 or 6 in 6 months time, 1 year's time, we don't know. But the move from 1 to 5 has been digested by these markets, which I think was a hanging sword all along. So to that extent, I think there is greater comfort in these markets.
So every year in your previous avatar, your firm used to come out with a yearbook indicating investors where they should invest. What is the macro setup, where valuations are. Now, of course, you will not be publishing that will not be authored by you. But to your existing investors in 3P, if you have to write a Diwali note talking about the lay of the land, how will that note start? How will that note end?
No, so we publish a quarterly and what we have said
Please
is
put it on the website. Everybody wants to read.
okay,
You're not
minus the
responding to that.
portfolio, we will do that. We can do that actually. So I think the growth rates will accelerate.
Okay.
See, one thing which we did not discuss, this remote working has brought huge dividends for India. So the global companies are now shifting a lot of jobs to their India offices across functions, accounts, taxation, legal, back office, HR, engineering, payroll. So if you see the net exports of services X software, that number was flat for 8 years. It is now going up like this. So whichever company you talk to, whether it's a bank or engineering company or a automobile company, the number of jobs in India is just shooting up. So I think you will create more jobs, more purchasing power. It will reduce India's current account deficit. So current year current account deficit is likely to be 1.5%, which is lower than the past. Growth rates will accelerate, one because of this and two because of manufacturing. One slow change in India has been the vast improvement in infrastructure. See, because
Bombay mein to khadde hain sir. Delhi mein fog hai.
See, leave city life out of it.
Okay.
Cities in India are very crowded. The inflow of people to cities keeps infrastructure always a challenge. But think of a business, ports, airports, power, telecom, intercity roads. These are good. So infrastructure for business has improved. Infrastructure for citizens, it is still always a catching up because the cities are growing so fast. The digital infrastructure in India is probably one of the best in the world. So I think business conditions are good, external environment is supportive, growth rates will accelerate. So I think the economic growth outlook of India is strong. Corporate leverage is at a 15-year low. Bank NPAs, as you said, are not there. So I think you can tick literally all the boxes as far as macro is concerned. Companies are making money. Corporate profits to GDP is back to 5%, which is where it was post Lehman. So I think net India is in a very good space. Many other EMs are out of favor for some reason or the other. So we are globally also looking.
Some are sick or some are unwell, but nobody is very fit and healthy globally.
Or some are, their behavior is disliked by the world. So I think we are looking quite good. Markets, I think, are fairly valued. Fairly valued means no multi-baggers in this market, but these markets offer you compounding opportunities. So I think if you remain invested.
थोड़ी क्रिकेट की बात करते हैं, right? मूड तो क्रिकेट का है. So let's look at cricketers. Going forward, who do you think will be the Shuman Gill of the Indian market? Nobody knew about them 3 years ago. Today everybody is talking about that.
So you will kill me for this, but I have never watched a match. I don't know even ABCD of
क्रिकेट नहीं थे आप देख रहे हो इतना इन्वेस्टिंग so what keeps you busy if not cricket and if not investing
when I am not into cricket.
okay never mind but thank you very much for joining us on Diwali and just so beautifully you just narrated in 30 minutes that where there is why the big picture for India is strong, what is the positioning of the economy and how by being a disciplined investor and being a patient investor you actually can just enjoy the joy of compounding. That's something I'm very vocal. I've learned from Prashant over the years that stick to your template, follow a discipline, power of patience, and then the most important P for is performance, which you'll always get. Really appreciate your time. Ye Diwali Muskaan wali. Let's close with a smile.
No, thank you.
Performance wali nahi, cricket nahi to दूसरी वाली performance है ये तो.
No, pleasure.
चलिए, thank you very much.
Bye.
Back with first trades right here, Neeti. Now let's just revisit what the first trades have settled in at, because it definitely was a bit of a quiet start for a third consecutive day this week. We've actually chosen to consolidate, and we're still consolidating, in fact dipping a little bit lower. Now you've got the Nifty futures as well, which have breached that 19,400 print, and it's a downtick of a good 0.5%. So finally aligning ourselves with how the rest of the globe has been, and this is of course the futures performance that I'm talking about. What's dragging us lower? M&M being the top draw on the index yesterday. It's the complete opposite picture. It's the top drag. 1.5% lower. Asian Paints is down 1.5%. Apollo Hospitals, Hero MotoCorp, Tata Motors, all of these stocks are the ones which are dragging. Amongst the heavyweights, Reliance, after that 1% downtick, it's down another 0.5% in today's trading session. ITC, Infosys, IndusInd Bank, ICICI Bank, L&T. Clearly, a wave of profit taking all across is what you can witness. But let's shift focus. It's time for festivities. So let's focus on how the trends so far this festive season have been. We've got Landmark Cars and we've got TTK Prestige both. Let me welcome on board Sanjay Thakkar from Landmark Cars joining in right now on the show. And we also have Chandru Kalro, the MD at TTK Prestige, joining in on the show right now. Gentlemen, both of you, great to have you both on the show. And firstly, here's wishing you a very happy Diwali from all of us here at TT now.
Yeah, happy Diwali to you too.
Happy Diwali and happy Dhanteras to all of you.
Yes, indeed. Hope it's a prosperous and sparkling one the year ahead. But Sanjay, if I could come to you, clearly the theme of the last somewhat has been premiumization. I mean, and who better than your company, who must have got every, detailed account in a bird eye lens, on a fish eye lens rather, on how this premiumization trend has panned out. Tell me more microscopically how the last month or so has panned out post-Shraddh since Navratris.
Yeah, so the good part about our country has been that we have had an extended festive period. Let me kind of say that we have been in a kind of a festive zone as far as the auto sales is concerned, not like in the last month, but for maybe the last 1.5 years. So the month-on-month sales has been increasing. We have been setting as an auto industry a new record every month. The dispatches, the wholesale, the retail has been happening continuously. And talking about the premiumization, it is real. I mean, the statistics are all in front of us. For example, our company, the average selling price has gone up 15% to over 20 lakh rupees is what we now sell without the GST. That's our average selling price. Who would have thought such a thing would happen? And it is continuously increasing. So the festive period, which began after September, has seen further uptake from a very high base that we have, and the good times continue.
Hi, morning. What's been your reading of how the festive season A has picked up and how the year ahead is going to likely to be? Because you pretty much cover the entire spectrum, right? From affordable up until the premium product range.
Is that question for me?
Yes, Chandru, for you.
Yeah. Hi. we do cover almost the entire gamut, not at the super premium, but everything from mass to mass premium, to tell you the truth.
Oh, we seem to have snapped that link. But if we can continue the conversation, Sanjay, with you, because it's been an interesting one, particularly in the last quarter, with quite a few brands like M&M as well in the portfolio. In the car segment, amongst all of the foreign brands, now you have a pure play Indian brand as well. What was the rationale behind this? How is it likely to, do for you?
Yeah, there are two aspects that one needs to consider. One is that Landmark, as a strategy, has decided that we will be focusing only on premium vehicles. And by premium, we define it by an average selling price, which is upwards of 10 to 12 lakh rupees, because that in India is premium. This is without the GST. Mahindra and Mahindra has been the fastest growing brand in India. And this was something missing in our portfolio. We needed a stable brand, some company which is focused on SUVs, which is committed to India's growth, and their EV strategy is about to play out. So this is something which absolutely fit like a glove with us, and I'm sure Mahindra and Mahindra also would like their dealers to be now premium car dealers. So this is where we have signed up with them and MG Motors, the two fastest growing brands in India. And our operations of Mahindra and Mahindra should be there from next quarter onwards. And I hope that we have a bigger play with them going ahead.
But Sanjay, considering your spectrum is now pretty large, from the most high-end and super expensive cars up until M&M, which of course, like you said, for many the definition is pretty much premium. Anything above the 20 lakh category in India is called premium itself. But when you come and, when you talk about, Mercedes and the likes, for instance, you think demand is more concentrated in that segment?
The thing is that the average age of what people, our customers in, say, Mercedes-Benz has been coming down rapidly. So it's now in the mid-30s is what people buy the top-end vehicles. Also, we have seen salaried people, women buyers. So it's actually the base is increasing. It's not a concentrated buying. If that's what you mean by the word concentrated, it's actually spreading. The number of people who are buying these luxury cars, the inquiry levels are so high. And the conversions today are maybe 10% of what we get as inquiries. So it bodes very well for the future. The aspiration of the nation is increasing. The buying power is there. The purse strings are now open. There is a feel good. Our business is many a times sentiment driven, and the mood of the nation is good. So this is something we believe will help us in the future.
Gentlemen, I just want to take a quick detour and look at the listing that's at the bottom of your screens. ISA Small Finance Bank, and it listed at about 72, so a bit of a premium to the issue price. The expectation was that it would be close to a 20 to 25% premium, which is what they have delivered. They do remember that the IPO had seen pretty strong response as well from investors. It got subscribed close to 73 times in 3 days of bidding. The issue size as well is fairly small, and the previous issue of the same segment, which has Ujjivan Small Finance Bank, of course, has done quite well for a lot of investors. So there you have it. That's the listing of the day, ISA Small Finance Bank. All right, to get right back then to our discussion, and Chandru Kalro is right back with us. He's the MD at TTK Prestige, and you were going ahead and telling us a little bit more about how sentiment is looking pretty strong. So give us an in-depth analysis as to how demand has been.
So as I was telling you, we are from the mass to the mass premium. We are not in the luxury. Yeah. But even in the segments that we are there, what we are seeing is definitely upgrade is a theme. So if people are buying for themselves, they're definitely buying something that is better than what they have today. So in every category, we are seeing that upgrade as a theme playing out. And I think that is what Sanjay also said. It is a sign of the kind of times we live in and the kind of aspirations that our customers have today. So we are very confident that as our innovation pipeline falls in, people will adapt to this upgrade theme more and more.
Okay, so when you say more and more, what is it in terms of the categories that you're expecting to do well, given that you spoke about being available across categories? And are you expecting then, further discounts or more festive offers or something like that? Because we're also looking at the premiumization trend that's doing very well.
So the festive offers and discounts are almost a matter of habit every year, and that happens during the season. I am talking about more, long-term trend that we are seeing, and the themes of convenience, anything that will help people upgrade their lifestyles, not necessarily just upgrade the activity that they are doing, I think is meeting with favor by the customer. And our product development is going towards that. So we have a lot of products that are focused on health, on convenience, on time saving, and on aesthetic, because people are becoming more and more sensitive to these things. And these are the themes that are doing well. And that is why, in the long run, the discounting will lose favor and brands will start winning. And that we will see as the share of wallet also improves towards the kitchen.
Okay, fair enough. Now, Sanjay, last quarter has, just wanted to talk a little bit about going ahead as well. The Diwali premiumization trend as well. Do you think that going forward, we are likely to see difference in terms of consumer behaviors? Will you be likely adhering to that in a different manner? I know you spoke about, the high-end Mercedes, etc. But the question is that do you see this trend sort of continuing, and how are you at Landmark looking to adapt to it?
Yeah, absolutely. The trend is going to continue. In fact, the demand for high-end luxury cars is more than the supply, even now. So as soon as the supply kind of normalizes and it matches with the demand, you will see more of these luxury cars on road. So I think it is now a one-way street. It is something that the nation has chosen. We want better, safer products, more luxurious products to kind of consume. It need not be in the top-end luxury. Even in the premium segment, the top-end models are selling. The SUVs with a lot of features are selling. So that is the customer has spoken, and I believe the writing is on the wall.
Okay, Sanjay, Chandru, both of you, thank you so much for joining in and giving us a color on how, or rather what color the consumer will choose this Diwali. And it seems like the uptick is pretty much intact and demand across the spectrum seems like it's in a robust shape. Good to have you both on the show, and happy Diwali once again. Well, as we step into a new Samvat, ET now brings you a whole host of market insights to decode what's in store for the new year. So this Diwali, get ready, taiyar hokar aaiye, and stay tuned for a very special Diwali programming. And now let's welcome on board Sunita Reddy, the MD at Apollo Hospitals, and chat about how their earnings have been. Ms. Reddy, great to have you on the show. Your occupancies this quarter gone by have improved by 68%. As we head into the second half of the fiscal, do you see it improving to, say, 70 plus levels?
Well, I think, it's important to see the correlation between our loss and occupancy. We are at 68% occupancy, but our loss has reduced to 3.26, which is a 5% drop. So if we didn't have the 5% drop, we'd be at 70% occupancy. So with this current loss trending as it is now, we should, be able to maintain the 67% because of, reduced number of days where we're, unlike other hospitals where the loss is higher.
Right, Ms. Reddy, now on the health core business, what is the target GMV that you have in mind for FY24, and what is the internal estimate when it comes to breaking even?
So currently we are at GMV of 725 crores, and this has been growing very strongly by 147%. So our target is 3,000 crores of GMV, and we will definitely achieve this. Break even for Apollo Healthco in totality will happen in the fourth quarter of this year, and break even will happen 4 quarters later for the digital. So it will become profitable in 2026.
Right. Since we're talking about, Healthco, Third quarter was the intended timeline for the fundraise. Given how things are today, do you see it happening soon, and at what valuation then?
I think we've always maintained that we would only dilute at the right valuation. And, as we've looked at the progress made by 24/7 this year, it has been very good. So the entire loss was only 39 crores, out of which 34 crores was attributable to ESOPs. So technically only a 4 crore EBITDA loss. And with this trend, we believe that the valuations that we get should reflect the quality of growth in the company. Having said that, there is no need for this year, no need for immediate cash infusion. It is being supported by 130 crores of EBITDA coming from the back-end pharmacy. So clearly, there is cash for growth existing within the company. And at the right valuation, we will look at a 10% dilution.
All right. And what is, what I'm inferring from what you're saying is that as of now, you're not in a hurry. So most likely not this year, right?
At this current rate, there's no pressure to really sell. We are introducing some products next year. So at that time, we have people who are interested to take a stake, and we want to be able to launch those products before we really do, take in capital.
Right. The reason we asked you about this fundraise was to get a sense of how you're going to be funding this 3,400 crore rupee capex that you've lined up. Should we expect then more debt on the books?
So as you look at it, we're adding 1,100 beds this year, and we're deploying about 1,300 crores of cash. So clearly we have 600 crores of bank, we have balanced with mutual funds, etc., and 600 crores of cash flow. So we're good for this year. It's a very calibrated expansion plan. We have headroom for debt because our debt to equity is now below 0.4. So there is room for us to take debt, but it is not required this year.
Will it be organic or inorganic? Because hospitals have been one of the hottest M&A sectors this year. There were talks as well of HCG, Aster, etc. being on the block as well.
So we continue to look at acquisitions, and we've done some bolt-on acquisitions. I mean, last quarter we did Kolkata, we did Future Hospital. We're adding 330 beds there. And this quarter we finalized a hospital in Pune, which comes at a cost of 670 beds. First, in 2025, 24-25, we will have 250 operating beds in Pune, and it's scalable to 450 beds.
Right. And what about the capex? What would it do to the ROS? And, it's currently at 28% for hospitals, as we understand.
So currently it's at 28% for hospitals. And this is really what we're tracking, because a big capex will happen in the hospital space. We believe that 20% is a hurdle rate, so it will not drop beyond that.
What about diagnostics growth? Because the target there was 500 crores this year. Are you sticking with that? And what about margins then?
Yes, we're on track for that. We've done about 150 crores of revenue in the diagnostics, and margins have also improved to 12%. So there is an investment being made into the diagnostics of 150 crores over the next few months, and with that we should be able to grow it significantly.
Okay, so how much has been the growth in ARPOB this quarter, and what is the outlook in terms of how the payer mix really helped the number?
So our ARPOB improved by 14% to 57,380 rupees. And, I think the payer mix, the change to insurance. So we have a very healthy payer mix currently. We have about 40% who are walk-ins, and we have 40% which are insurance. And then we have about 7% international patients, and this has grown by 18%. So we continue to see growth in that. And the rest, we work with state governments and Ayushman Bharat.
All right, Ms. Reddy, good to have you on board. Thank you so much for joining in. Tell you what, with news that the index is at 19,350, we'll take a quick break. We'll identify a lot of the movers and connect with corporate voices when we return.